Gabriel India, one of the leading shock absorber manufacturers, reported a decent set of numbers in Q4 FY22, driven by a sharp rebound in demand post the pandemic. However, raw material prices continue to put pressure on the margins. What continues to boost our confidence in the company is the sharp rebound in demand across segments and its leadership position. Further, its valuation is at 16.9 times FY24 projected earnings, and that's lending more support. Gabriel's net revenue grew 17.7% YOY, led by a sharp rebound in demand across segments post the pandemic. Segment-wise, revenue growth for the 2-3-wheeler, passenger car and the commercial vehicle segments was seen at 14, 23 and 30% respectively. Exports remained muted in Q4 FY22 due to subdued operations at the Volkswagen Russia amid the geopolitical crisis in Russia. Raw material prices continue to impact the operating profitability of the company. In Q4 FY22, its EBITDA margin contracted by 319.6 basis points YOY. FY22 was beset with multiple challenges, such as the rise in fuel prices and severe shortage of semiconductor chips, which impacted entry-level demand. This led to the deferment of production schedules by many OEMs. However, a sharp pickup in demand came to Gabriel India's rescue. What is helping demand in the PV and the two-wheeler segments is a shift in preference towards personal transport, as people continue to remain wary of taking public vehicles. The changing consumer behavior will continue to remain a key growth driver for Gabriel, as it generates more than 88% of its revenues from these segments. Further, the replacement segment, which is 14% of the company's total revenue, continues to remain robust. Gabriel is leveraging its brand strength and distribution network to cater to the demand from the segment. In fact, the company currently has 40% market share in the replacement market. The management has indicated that the demand from the CV segment is expected to pick up fast after opening up of the broader economy. On the whole, we expect the demand momentum to continue. On the back of its superior product quality and a strong client base, Gabriel has established itself as a dominant player in the industry. It has a 25% market share in the two-wheeler segment, 65% in three-wheelers, 21% in passenger vehicles and 75% in the commercial vehicles category. Refreshed versions and new models being rolled out by OEMs are expected to help Gabriel. In the PV segment, it has started supplying for Maruti's new models. It is also at an advanced stage to bag orders for 2 new offerings of M&M, 1 model of Volkswagen, 1 of PSA and 2 of Tata Motors. In the two-wheeler segment, it has onboarded launch programs of TVS Motors and Bajaj Auto and is actively taking part in EVs being launched by Okinawa, Ather, TVS, Hero Electric and Ola Electric. In the CV segment, it has new programs with Ashok Leyland and DAF. Though the geopolitical situation impacted the company's performance in Q4 FY22, Gabriel sees a significant opportunity in the export markets like the US. The European OEMs have started reducing their dependence on Chinese manufacturers for component supplies. In fact, with critical deal wins from Volkswagen Russia and DAF, it has established itself as a strong player in the global market. Gabriel's stock is trading at 16.9 times FY24 projected earnings, which is very reasonable. We advise investors to buy this stock with a long-term perspective. The company generates most of its revenues from OEMs, and a slowdown in their sales would hurt its performance. Additionally, adverse movement in raw material prices can pose a risk.